every growth stock that trades based on its distant future earnings got slaughtered because that's the group that inflation hits the hardest. So you might wonder them, why the heck wasn't Rivian slaughtered too? And then it only produces 156 vehicles, most of which were sold to employees. I mean, this thing reeking of the out years kind of thing that inflation hurts, right? It's trading on what it could make in 2030. How can a stock like that price at 78 and close at $100 when the market's turning against exactly this kind of investment? It's simple. Rivian's not rallying in spite of the growth stock sell-off. The growth stocks sold off in part because of Rivian, as investors sold large ones, sold off similar assets in order to get as much stock in as they could or participate in the deal. So you got to understand how the market works if you want to understand Rivian. Given all the interest in this one, the Rivian IPO was practically guaranteed to be red hot. It was inevitable that it would go to a premium. In other words, that it would go above where it was priced. How much of a premium? Again, this is where Rivian stock distinguished itself as an entity separate from the pummeled averages. Successful underratings are all about something called allocations. Who gets it and who gets shut out? Usually the company comes public is pretty clueless about the process, so they let the syndicate desk be in charge. Normally that means lots of money managers end up getting sweet deals because the syndicate desk need to keep them happy, so they'll continue to buy new merchandise, so they'll continue business. It's a reward. But this time was different. This time, Rivian CEO R.J. Scaringe, he was able to call the shots because his stock was so in demand. So he decided to give it to the entities that would pay the most, the sovereign wealth funds and large institutions, not small-time hedge fund flippers or home gamers. He wanted to reward people who would stick with him, okay? I don't know the man, but obviously he's very thoughtful about this stuff. These accounts typically put in for 10% of the company's shares that are coming public. Obviously, they aren't going to get that much, but that's how you signal you want a ton of stock to the deal makers. So what happens is these gigantic non-flipping institutions then get a nice chunk on the IPO, but because they're so darn big, they need to buy much more if they're going to have what's known as a meaningful position within their funds. So they come in after getting their allocation and then proceed to sell the shares of fast-growing techs. We saw that selling all day until near the end of the day, and then they buy more Rivian shares once they start trading. And that's how a company like Rivian, that's only sold what amounts to a handful of vehicles, can trade at the same market capitalization as GM.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.